Welcome to Dollars and Cents, Creating Your Fulfilled Life with Nicole Romito from Private Vista. In this podcast, we draw from years of experience as well as guest specialists to help you create the life you imagine. Join us in this journey as we enlighten and empower you to align your lifestyle to help you achieve your goals with a clear picture of your future. Now, let's get to the show.
And welcome to the podcast, Dollars and Cents, with your host, Nicole Romito. Nicole, good to be with you again. How are you?
I'm doing great. It's good to be with you, Bill. How is life treating you lately?
It's been really nice. I have to admit, we're recording this at the beginning of autumn, and I love autumn, Nicole. It's just the most beautiful time of the year. So I'm pretty much always in my happy place at this point.
That's amazing. I love that for you. Same. We're having a gorgeous fall here in the Chicagoland area, which I think is keeping everyone pretty active and a good mood.
Yes.
Getting out and about, apple picking. I know the kids are getting geared up for Halloween and all that good stuff. So I would say life is good over here.
Yeah, and I'm going upstate next weekend, going to an Army game up at Mikey Stadium where the colors will be in full-blown on-fire trees. So,
oh, nice.
Yeah, it's great. What do you have in store for us today? What's on the table?
Yeah, so I have Randy Porzel, who I think for our longtime listeners, he's been on the podcast before. So we've known each other for a handful of years. So welcome back,
Nice.
Randy.
Thanks for having me.
Absolutely. And what we're going to talk about is, as you follow the markets and as the S&P continues to be heavily influenced or impacted by a handful of tech stocks, Randy and I are going to have a discussion about how to assess and address if you find your portfolio heavily influenced by one or maybe a few stocks. And we're going to share some, how do you go about assessing it? And then what are some possible options or solutions to address it? So that's our topic at hand today.
Fantastic. I can't wait to hear about it because I own quite a few tech stocks myself and so far have done rather well as I knock on wood.
Yes. Well, good for you. But you might want to take a few notes during the podcast.
I'll be standing by listening. You got it.
Perfect. So just in case our listeners did not catch the prior episode that Randy was on, I'll give a little brief bio. He began his financial planning career as an intern and at Private Vista, and he has worked his way up through every job at our company. He has spent hours in meetings with clients, asking questions and observing. He really has learned to recognize expectations, how to provide the client with clarity, and, how without having a plan, that might cause them for an unnecessarily anxious future. I've seen him in action, and he's really good at taking our clients through the planning process and using the tools and knowledge and experience to help them answer the questions and clear up uncertainty so they can look forward and, plan and live their idea of an enriched life. So welcome back, Randy.
Thank you. Looking forward to it.
Yeah, absolutely. And just really quick, when you are not busy working with me and our other partners and helping our clients, why don't you tell us a little bit about what you, your lovely wife, Jenny, and your two adorable kids enjoy doing?
Yeah. So Matthew and Brooklyn are my two children. 9 years old and 6 years old. So you can imagine we have a pretty busy household. So we're bouncing around between different campouts and gymnastics and theater practice, homework and studying. I mean, it's a busy household these days, but we're having fun.
Yes, well, that is the name of the game. So thank you for taking time out of your busy life to spend some time chatting with me today.
Thank you.
Great. Well, why don't we jump in to talk about our topic at hand? I know the first thing we wanted to kind of lay the groundwork for is really when you're assessing any type of investment and whether you want to make it, whether it makes sense for you, is I know here at Private Vista, our first step or the way we're going to lay it out is how does this impact your overall financial plan? So why don't you kind of walk us through that part of the process when we're chatting with clients?
Yeah, so the last time I was on this podcast, I started it talking about how, as Private Vista at its core is a financial planning firm. We build financial plans for people, and then we help build around that plan to make sure that people can meet their goals. So really where we start with people when we're talking about a concentrated stock or any type of position is we want to look at their plan and understand what they're going to need in retirement. And then as we look at that, how much risk does some person need to take in order to meet that plan? So when we'll talk to someone, for example, they might say, hey, we'd love to be able to take 2 vacations a year, for the rest of our life, or at least as long as we can. And so when we start to look at the various positions in their portfolio and the risk they can take, we start to think about what type of risk and what type of investments do you need in order to meet that goal? And what would happen if we got overly concentrated and all of a sudden you couldn't do those goals? And I'd say for the most part, most of our clients would rather take some risk off the table in order to be able to meet their goals instead of trying to quote unquote roll the dice in order to, make their net worth 2 or 3x.
Yeah. And I think one of the things we've consistently found when we're walking clients through their plan for the first time is it's a little counterintuitive where they actually we project a higher likelihood of success that they're taking less risk with their investment portfolio.
Yeah, because if you kind of just looked at the trajectory over someone's lifespan, you talk about 30, 40 years, the riskier your portfolio, has the probability for higher returns in the future, but
right,
also
which everybody likes,
which we all love, but also has the risk of potentially running out of money sooner. And so what our goal is try to find that happy middle ground for someone to make sure that we take some of the volatility out or risk out of their plan in order to be able to make sure that they can confidently do the things that they want to do in retirement.
Yes, absolutely. And I think, we'll kind of talk through all parts of the life cycle, but we certainly have found as once clients are needing to replace their paycheck or their earned income, oftentimes, again, we really haven't had any issues with the upside volatility. But when you are actually in withdrawal mode and not adding, riding out the inevitable downturns or pullbacks in the market, which are fully expected and a normal part of the investor experience, it could be a lot harder, though, to stay the course when you are actually, taking from the portfolio.
Absolutely. Yeah, you definitely want to look at risk reduction strategies in there. And that doesn't necessarily mean buying only conservative investments or not holding any of a position of a stock that you've had a really long time. But, building it as part of an overall strategy and an overall goal, not trying to time the market. Ultimately, that is impossible from our standpoint. If I was able to time the market, I would fly you all out to beat on my yacht in the Mediterranean, but we won't be doing that.
I'd like to be first in line for that, please.
Absolutely. But unfortunately, we can't do that. And I think what we need to learn over time is that sometimes we could all have the best plan or invest in the best company, but sometimes bad things happen to good companies. So if you own any individual stock and let's say it becomes 70, 80% of your total net worth, there are some things that are completely out of your control or out of the company's control that can completely dictate it. Sometimes a stock can decline for no fault of their own. Maybe the CEO does something wrong or one of their particular products hurt somebody or something. Well, then obviously that's going to have an impact on the stock price itself. And then there's parts of the economy that we may not be able to control. So you could have a downturn in the economy, and while a company continues to perform really, really well, they could see their stock price fall just because of an economic downturn. So there's a lot of things kind of other than just looking at a company or working at a particular company that you want to take into play.
Yeah, absolutely. And I think too, as we look at, as I mentioned, kind of to tee up the topic is, if you're comparing your portfolio or your performance to the S&P 500, that sounds at face value like a very diversified index, at least for the US stock market. It's the 500 largest companies in the US across 10 or 11 different sectors. But what we have found is because it's market cap weighted, which means the larger the value of the company, the more impact it has on the overall performance of the index. We have found really over the last several years, really over the last 10, 12 years, it's become more and more of a tech index, but more so over the last few years, really a handful of the, power players in that arena, which, listeners, if we gave you one, couple of chances, you'd probably be able to name them all. So why don't we talk a little bit about that, whether people feel like, hey, I've got the S&P 500, so I'm diversified, or we've also seen, companies that were really the darlings of the market as we were going through the pandemic. So
Yeah,
you want to tease up some examples?
that's a really good point. I mean, during COVID, especially in late 2020 and early 2021, we saw a lot of inflows into certain companies like DocuSign and Zoom. And hey, I'm never going to be able to go to a gym again, so I'll get a Peloton. Or I'm never going to be able to go buy a car at a car dealership, so I'll buy Carvana. And
Right.
you've seen a lot of these companies that saw really, really big spikes and a lot of money flowing into them kind of at the peak during COVID. And some of these companies have never recovered. They're down 80-90% since their height during COVID. And they've kind of leveled off today at a certain valuation. And you're sitting there with people who bought these at the peak where they've just seen their portfolio really, really decline and the inability for them to recover kind of in the short term. And, even though I agree 100% with Nicole with what you said about the S&P 500, but if you compare any of those individual stocks to kind of what the S&P 500 has done since that same period, the S&P 500, even from its peak in COVID, is still up another 25%. So, you take a look at these and you realize that, getting some level of diversification in your portfolio can really not only reduce the risk, but in this particular case has been able to enhance your return along the way too.
Yes, absolutely. I know when we have kind of these single either industry sectors of the market, or certainly, certain companies, they may have, short term. And as I said, the short term has been longer than normal. It's been several years for certain stocks. Really what we're trying to do though is they have had pullbacks or sell-offs along the way. And so to your point, by diversification and asset allocation still work. And it is kind of the whole steady Eddie wins the race over the long run.
Absolutely, because we'll look at a person's financial plan and we'll say, look, if you earn a decent rate of return along the way and you do the things that you're saying going to do as far as what you spend and what you're able to save, what we realize is, look, you're going to be able to accomplish everything that you want to accomplish.
Yes, I agree. And two, with some that have had, steep run-ups, not saying the company's gonna, maybe peter out or go out of business, but at some point, the potential to continue to grow earnings or revenues and things like that at that pace is gonna kind of plateau off.
Absolutely. And it's a really good thing to know as far as what you can not only stomach from an emotional standpoint, but from a financial standpoint. So, as you're looking at your financial plan, something important to ask your financial advisor is, what does my plan look like if we see a 10, 15, 20% decline that isn't able to recover? By you having that information, it kind of arms you with that to know, hey, what type of diversification do I need? There's some people where they may have a concentrated position, but they may have enough wealth that if they saw a 20% decline in that position, it wouldn't impact their ability to be able to meet their goals. That's going to be a very different strategy than someone that sees a 20% decline. And now, instead of those 2 vacations they want to take a year, now they're looking at 1 or maybe every other year they'll be able to take a vacation. These are real things that people need to think about, other than the fun side, which is, wow, look at my stock, it keeps going up and up and up. unfortunately, sometimes we have to be the voice of reason sometimes to say, okay, well, what if it doesn't keep doing that? Or what if it goes the other way? What's the potential impact to the security of your finances at that point?
Yeah, especially as if it is going the other way and, it's down double digits and it's not just a blip like, oh, it was a day or a week or a month. Are you able to stick with the strategy or with your holdings, if you will, to hopefully ride it through? Because we have seen, especially again, when you are no longer working or have earned income coming in, once you start taking money out, you can't recover if you're selling during these down markets, because you need the money to be able to pay the bills, right? Not even just for discretionary, but you still need to have a roof over your head, food on the table, etc.
Yeah, absolutely. I mean, we'll get questions all the time from someone who say, "Hey, I'm 40 years old. How should I invest?" Or "I'm 60-year-old. How should I invest?" And there's so many more questions before we can answer that regarding what type of risk someone can take, what do they want to accomplish, how long do they want to work for, what are the really things important in their life. Because what I tell people is we have plenty of younger advisors that are really good at saving and not comfortable with a lot of risk. And then we've got, some clients that are 70, 80 years old that really, really like the risk and they have a secure plan and they know they can take it and they view that as kind of building their portfolio for future generations. So there's all different ways to build that financial plan and build a portfolio around that.
Yes, I agree. It's, a lot of times there's the rules of thumb, take like 100 minus your current age, and that's how much you should have in stocks and, things like that. But it really should be individualized based on, what are your resources? What are your goals? What is the age you are aiming for or you've arrived at where you're financially independent? To your point, there's not always the reason, or it's not always the best path to go more conservative once you reach that time of financial independence in your life.
And for someone who's living on their portfolio, don't forget cash is king. I mean, cash is good to have. And I know when the market's doing really well and your cash is just earning a couple, 2, 3%, I understand that is a really tough place to be. You just feel like, everyone's out having fun. And
Yeah,
here
all this
you
missed
are.
opportunity.
Absolutely. But what the cash is there for is to be able to weather a storm, which we're going to see and they're going to happen.
Right.
It's to weather those storms during that periods of time, take some pressure off the portfolio when we're in a down market. And when the market's doing really well, we replenish that cash position. So cash is really important when you're in that stage of your life.
Absolutely. And along with, I'll just add one other point, and then we're going to pivot to, I know what are some of the ways you can diversify or get away from a stock concentration. The other thing to figure out too is, do you have any income streams? So Social Security, a pension, maybe you have some annuities in the portfolio or things like that. But it's really important to focus on all the sources, all the resources, which could be an asset or a stream of income.
And who are you planning for? If it's for example, are you planning for just you? Are you planning for you and your partner? Are you planning for potentially you and your partner and maybe an extended family? Who are you planning for and how would that income continue if God forbid you were to pass away?
Perfect. Well, I think we've really set the stage, at least how here at Private Vista, we do believe that any portfolio or any holding in it should really be evaluated in the context of your overall plan and what, as you just said, what are you trying to do and who else does that include in your plan? So why don't we talk, Randy, now a little bit about if you do find yourself, I mean, we do have clients, whether they were an executive at a public company and a lot of their compensation came in the company stock. Or as we mentioned kind of at the top of the hour, we have found clients because of the, in general, outsized performance of some certain stocks, they may not even realize or not have known until we're doing a review. Wow, Nvidia is 25% of my portfolio, or Apple, or, things like that. We've also seen on the other side, a couple of the darlings have, starting to kind of fall from grace. We'll just pick on Tesla for a moment, if you will. So we've kind of seen them run up and run down. So why don't we talk a little bit about how we have, what ideas or thoughts that we may have when we're chatting with clients about this?
Absolutely. So when I'm in meetings, you'll hear me say this more than a couple of times, but I'm a big fan of balance. I love balance. I love, taking a little bit of risk in parts of the portfolio where it makes sense, taking the risk off the table in other parts. So if we're looking at someone who has a concentrated position, and we start to look at ways to kind of de-risk their overall portfolio and around being able to accomplish their plan. So step one, kind of the easiest one that people think about, is you can just start to sell shares. And there's a little bit of a strategy around how you do that. So I'd say the first thing that you do is you look at all the shares in the individual tax lots. So every single time you buy a particular stock, or every time that potentially you're granted stock from your company, it creates a new tax lot. And for each one of those, you might have bought a stock 10 years ago, and that may be up 30%. And you may have bought a stock, a year ago that may be up 2%. So it's really important to look at the individual lots and find ways to be able to diversify away from the ones that would minimize your tax bill.
Hey, pardon the interruption. I know you are listening to Dollars and Cents, Creating Your Fulfilled Life with Nicole Romito, and we're happy you're here. If you have any questions, please head over to myprivatevista.com or the show notes to find out how to reach us. We'd love to hear from you.
And especially, one of the other kind of strategies as you're doing that is to look at, capital gains rates. So if you look at it today, as it stands today, if you're a single person, you can earn up to $518,000 a year and still be able to pay a capital gains rate of 15%. If you're married, that number jumps up to $583,000 a year. So there's a lot of room for some people to be able to realize some of those gains at a relatively favorable tax rate at that 15% rate.
And I just want to add on for our listeners, that's at the federal level. You'll also want to check, many states also tax capital gains as well. So you'd need to check with your state law to see if they do and then how they do it.
Absolutely. And as we mentioned earlier, we talked about not trying to time the market. A lot of people will say, well, I'm going to wait a little bit longer. Unfortunately, there's a lot of people that have said that and their stocks never get to that particular point. So there's risk reduction strategies that you can employ in your portfolio as a way to say, hey, look, I want to protect myself on the downside. And ultimately, in order to do that, I need to cap myself on the upside. You can do that in the form of options. We use a strategy called a cashless collar at times, which allows you to sell a call option, which limits your upside potential. So if you have a stock at $10 and you sell a call option, if it goes above $12, you may, have to sell that stock at $12. But someone pays you for that option, and then you can go and take that money and you can buy yourself what we call a put option in order to protect yourself on the downside. So these are kind of two different products inside your portfolio that allow you to protect yourself on the downside and still participate to a certain extent on the upside without having to pony up a lot of money in order to do it.
And one thing I just want to add on is, even though we're talking about being, over concentrated in, one or a few handful of securities, it doesn't mean you have to sell or do a full liquidation of that holding. Where Randy and I are coming from, or how we've helped our clients, is more like, let's talk about what is a reasonable amount to retain, so you're not having so much dependent on one or a few companies. But these are ways where we can start to chip away or reduce that concentrated position. And the other thing I like about this particular strategy, and I think we're going to continue down this theme, is by having a plan, a couple of things. You're not trying to time the market, and you're taking emotion off the table or out of the equation from the particular shares or amount you're going to sell. So we've seen it where clients might say, well, it's on a tear, or they're going to release a new product or the next version or reiteration of something. I think the price is going to go up by double or triple. Okay, well, then let's not sell everything, but let's lock in some of the gains or take some of the chips off the table today.
Absolutely. Again, it's about balance
Right.
and
I love
being
it.
objective and developing a strategy and sticking to it, regardless of what your emotions tell you to do. Our emotions in the investing world tend to lead us in the wrong direction. Emotionally, when stocks are really high, we want to buy more, we want to hold it longer. And emotionally, when stocks are bottoming out or at really low values, we want to sell them. That's what our emotions. And anybody that's ever listened to Warren Buffett and talks about, buying low and selling high, emotionally, our minds and hearts tell us to do the opposite. So be objective, develop a plan, and sell your shares over time. Look at the individual tax lots and, make sure that you're able to do that. We're going to have some executives that can only sell during certain windows. Take advantage of those windows when you can. Realize how much stock you want to leave on the table. Maybe that's 15%, but also realize that your job is tied to it too. So if the company sees a downturn, you could find yourself losing value in your net worth due to your stock. You could see yourself being laid off or losing your job. So really what it's about is doing a little bit over time, figuring out how much stock you really want to hold at the end of the day, and then being objective about a strategy to reduce that risk.
Love it. So why don't we talk a little bit about if maybe selling isn't the best, it's not the only option, but maybe the capital gains taxes are going to be pretty hefty, even though they're at that more preferential rate of 15% at the federal level. Why don't we talk a little bit about another way to reduce your exposure is you can give away the shares.
Absolutely. So a lot of our clients really happen to be very charitably inclined. And so the way we think about this is if someone's making a charitable donation for whatever, they're giving maybe $1,000 to their church. There are a couple ways to do it. One, you could just write a check. Or two, you could donate, your appreciated stock. So if you work for a company, your stock has done really, really well, you can transfer that stock over to the church or the charity that you're looking to support and get the full benefit of the deduction as if you wrote a check, but now you've eliminated that capital gains tax and you've been able to do it at a stock that you probably paid significantly less for.
And you get dollar for dollar goes to that charitable organization.
Yeah, absolutely. Charities don't pay capital gains taxes. So they're able to sell the position at no tax, and you're able to shift that tax really into thin air, which is really a good place to be.
Yeah. And just for our listeners, if we did do a full episode, it's episode number 27, how can donor advised funds be used for estate planning? So if you'd like to do a deeper dive into charitable giving, please check out that episode for more details.
Yeah. And we also, another thing, it's that sometimes people aren't always transferring stock over to a charity, or sometimes they're looking at building gifting strategies for their family to be able to support their children and their grandchildren kind of throughout their life. And so one way to look at it is to understand as you think about gifting strategies, does it make sense for you to gift some of the stock to your kids or potentially grandkids? Now, there's different rules and things that you want to keep an eye on to make sure that the tax burden doesn't overwhelm them. But ultimately, if you found someone in a lower tax bracket, then you shifting some of that stock to them in the form of a gift may be able to weigh as you look at kind of family wealth and generational wealth transfer. You may find a way to minimize the tax burden doing it that way as well.
Yeah. And I think we're not going to do a deep tax dive, but just as Randy mentioned, the upper brackets for the 15% capital gain, bracket, there's also a certain amount of income that actually pays 0% in capital gains. So that's where it could apply to the kids. But then there are many people might be familiar with like the kiddie tax rule. And that's what Randy's referring to is you just want to make sure you're working with your accountant or CPA to understand what are the different levels you can do so you're not inadvertently creating unnecessary taxes or surprise taxes.
Yeah. And, lastly, on the capital gains piece, while we all, love talking about our stocks going up, we hate talking about having to pay the tax on that. But there's another side of the portfolio as well. You may see, depending on the economic cycle that we're in, you may see certain positions that have not done really well. And while most of us say, hey, I want to stick in this position to see it recover, there are certain tax advantages of selling positions at a loss and using that loss to offset some of the capital gains that you incurred on selling other positions. So seeing positions down and at a loss isn't always a terrible thing if it can save you some tax dollars along the way.
Yep, absolutely. So save some tax dollars or avoid tax dollars, and then you can get into a more diversified portfolio. All right. Well, I think that we've done a pretty good job of kind of highlighting the fact of, first start with your overall picture. We talked a little bit about why, in our opinion, compressing the range of returns actually can help potentially lead to a more consistent and successful financial plan. And then we did talk about some strategies if you do find yourself, as we know many people out there today are, where you like, wow, this has really grown. I didn't realize it was this much of my portfolio. So how could I go about reducing, or if you want to eliminate that concentrated position? As we wrap up, Randy, is there anything else you either wanted to like highlight as a key takeaway or just touch on something that we had not yet discussed?
The only other thing that I'll mention is as you're building your portfolio, understanding kind of the different makeup of your investments and how they perform and how they generate different tax liabilities along the way. There's people that invest in stocks, there's people that invest in mutual funds, there's people that invest in exchange traded funds, or what we call ETFs. Each of them all have a little bit of a tax difference as far as how they're treated, whether they distribute capital gains from the fund, whether you have to sell it in order to incur that. It's important to look at each one of those and talk about that with your advisor to make sure that it's looking at your entire plan as part of it.
All right. Well, great. Well, as always, I always enjoy our conversations, and I really appreciate you taking time from your full plate of a lovely life to chat with me and our listeners. So thank you.
You're welcome.
And then, you've been on before, so I don't know maybe if you're going to revise your answer. I'm still closing with the same question is, if you had no time constraints, money constraints, school district constraints, where would you like to live and why?
Yeah, I think I am going to change my answer.
Oh,
I think as we all do, we evolve as we grow. Historically, I said I'd love to be on an island or on a beach somewhere. And I think over the last couple of years, my wife and I, along with our kids, have found ourselves, visiting various lake houses from friends or Airbnb and, sitting on a lake or renting a boat. And so the more and more we think about it, we really kind of like that, just sitting on a lake, seeing the sunrise, seeing the sunset, sometimes maybe with a little cocktail in your hand, but ultimately that's where I'd love to see myself living my Private Vista.
Oh, that sounds amazing. The sunset part. I'm not much of a sunrise kind of gal, but all right. Well, thank you so much.
Yeah, thank you guys.
Oh, thank you, Randy. I'm glad you had this conversation because I don't think enough people talk about the importance of making sure their portfolio is balanced. And, Nicole, for people who are listening to this conversation today via podcast, if they want to have a conversation with you about ways they can balance their portfolio and what they might want to do that they haven't thought about before, how do they get a hold of you and have that conversation?
Yeah, absolutely. They can, if they want to talk with me or Randy or any of our fabulous colleagues here at Private Vista, the best way would be to go to our website. On the homepage, there is a contact us button. Fill out your contact information, reference this episode, and then certainly myself or Randy, or again, any of the advisors here at Private Vista will reach out, and we welcome the opportunity to have an initial conversation. If you prefer to try to get in touch with us over the phone, you can call 312-831-4370. And then again, ask for Randy or myself, and we can make sure either we have the conversation or we get you in touch with one of our colleagues.
Fantastic. And for those of you who are listening to this podcast for the first time, you could do yourself a favor. Just reach out and hit that follow button and become a subscriber. That is that simple. And then once you're a subscriber, every time Nicole drops a new episode of the podcast, you're notified and you can listen to it. And, and if you like it, I would ask that you share it with people. If if word of mouth promotion is very welcome. It'd be nice if you find this podcast useful to share it with other people and tell them about it. And we thank you for doing so. Until next time, I'm Bill Tucker on behalf of Nicole and everybody at My Private Vista. I want to thank you for taking the time to listen today and remind you that you can go out today and make today a great day or not. It is your choice. Thanks for listening.
Thank you for listening to the Dollars and Cents Creating Your Fulfilled Life with Nicole Romito, sponsored by Private Vista. Visit our website at www.myprivatevista.com or give us a call at 312-831-4370. And don't forget to click the follow button to be notified when new episodes become available. Private Vista is a group comprised of investment professionals registered with Hightower Advisors, LLC, an SEC-registered investment advisor. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is neither indicative nor a guarantee of future results. The investment opportunities referenced herein may not be suitable for all investors. All data or other information referenced herein is from sources believed to be reliable. Any opinions, news, research, analyses, prices, or other data or information contained in this presentation is provided as general market commentary and does not constitute investment advice. Private Vista and Hightower Advisors, LLC, or any of its affiliates make no representations or warranties expressed or implied as to the accuracy or completeness of the information or for statements or errors or omissions, or results obtained from the use of this information. Private Vista and Hightower Advisors, LLC assume no liability for action made or taken in reliance on or relating in any way to this information. The information is provided as of the date referenced. Such data and other information are subject to changes without notice. This was created for informational purposes only. The opinions expressed herein are solely those of the authors and do not represent those of Hightower Advisors, LLC, or any of its affiliates.